Hey everyone, and welcome back to the channel. Are you looking for the next big thing in tech? The kind of stock that could transform from a small, undiscovered company into a future giant? Well, you've come to the right place. While the big tech names get all the headlines, the real growth potential often lies in the small cap space. These are the innovative, agile companies working on the technologies of tomorrow. But with high reward comes high risk. So in this video, we're not just listing names, we're diving deep into three of the most promising small cap tech stocks that are on our radar right now. We'll break down their business, their financials, and most importantly, we'll see what the analysts on Wall Street are saying about their potential. Let's get started. AVA Technologies, ticker AEVA. AVA Technologies is a leader in the next generation of sensing and perception systems, distinguished by its unique 4D LiDAR technology that integrates instant velocity detection alongside long-range distance measurement. Unlike traditional LiDAR, AVA's frequency-modulated continuous wave, or FMCW approach, makes its systems inherently resistant to interference from sunlight or other LiDAR sensors, while also providing the computational efficiency of delivering a camera-like megapixel resolution point cloud. The company's vision extends beyond autonomous vehicles, aiming to enable a wide range of applications in industrial automation, consumer electronics, and smart infrastructure. By offering a complete solution from its proprietary sensing chip to its perception software, AVA is positioned to be a key player in bringing advanced perception capabilities to various industries and powering the future of automation. First, let's get straight to the financials. For the trailing 12 months, ACEVA has reported revenue of about $13.8 million. Now, that's not a huge number, but it's crucial to see the context. This represents strong growth as they begin their early commercial deployments. The engine is starting, and it's a positive sign. However, they have a gross profit of negative $4 million. This tells us that at this very moment, it actually costs them more to make and sell their product than they earn from it. This isn't uncommon for a company scaling up production, but it's a critical metric to watch for improvement. The big number that jumps out is their net loss, a staggering negative $301 million. Their EPS is negative $5.35. This is the reality of their burn rate. They're spending heavily, over $133 million on operating expenses to fund massive research and development and scale their business. So, with losses that big, how are they still in business? This is the most important part of the ACEVA story. Let's look at the balance sheet. Cash and equivalents, over $100 million. This is their war chest. Debt, negligible. They have a very clean capital structure, meaning they aren't burdened by interest payments. This combination is their lifeline. That cash pile gives them what's called a runway, the time they can continue to operate before they either need to become profitable or raise more money. With a negative operating cash flow of around negative $107 million per year, they have roughly a year or so of runway left, which puts the pressure on for continued execution and potentially more fundraising. At its core, ACEVA builds LiDAR sensors. Think of LiDAR as laser-based vision that allows machines to see the world in 3D. But ACEVA isn't just making another LiDAR. They're making what they call 4D LiDAR. What's the fourth dimension? Instant velocity. While traditional LiDAR tells you where an object is, ACEVA's unique frequency-modulated continuous wave, or FMCW technology, also tells you exactly how fast that object is moving and in what direction, all in a single chip. This means longer range, higher resolution, and immunity to sunlight or other LiDAR interference. It's a potentially game-changing advantage for the demanding needs of autonomous vehicles and industrial automation. The bull case for AVEVA rests on three main pillars. First, the technology moat. Their FMCW LiDAR isn't just an incremental improvement, it's a fundamental architectural advantage. This makes it incredibly attractive for partners who need the best performance, not just the cheapest sensor. Second, strategic partnerships. Aveva isn't working in a vacuum. They have key collaborations with major industrial players like SICK AG and LMI Technologies. These partnerships are crucial footholds in the industrial and smart infrastructure markets, providing early revenue and validation. And third, a massive TAM. The market for advanced driver assistance systems, ADAS, autonomous vehicles, and industrial robotics is exploding. Aveva is positioning itself at the very heart of these megatrends. With new products like the Aveva E1D sensor, they're expanding their reach into even more applications. Now let's flip the coin. For all its potential, Aveva faces some very serious headwinds that you cannot ignore. The biggest issue? Financials. This is a classic pre-revenue tech story. In their latest Q2 2025, revenue surged an impressive 173%, but their net losses widened dramatically. They are burning cash to fund R&D, scale production, and chase market share. This leads to the constant risk of further dilution for shareholders. Then there's the competition. The LiDAR space is a bloodbath. You have well-funded players like Luminar, Velodyne, and a host of startups all fighting for the same handful of automotive contracts. It's a race where only a few are likely to win. And finally, the execution risk. Going from a brilliant prototype to high-volume, reliable automotive-grade production is incredibly difficult. Any delays in customer adoption or supply chain issues could severely impact their timeline to profitability. The consensus rating sits around a moderate buy or hold. It's a cautious optimism. The analysts who are bullish point to the unique technology, the growing pipeline of contracts, and the massive addressable market. They see a company with the potential to become a leader in its field. The more cautious analysts acknowledge the tech but are worried about the cash burn and the path to profitability. They want to see more consistent execution and a clearer timeline towards sustainable finances. This split is reflected in the price targets, which vary widely. Some see significant upside, with targets in the $30 to $35 range, while others are more conservative, waiting for the company to prove it can scale profitably.
POET Technologies, ticker POET. POET Technologies, Inc. is an innovative optoelectronics company focused on the design, development, and manufacture of advanced optical engines and light sources for the data communication, telecommunications, and artificial intelligence markets. The company's core technology is the POET Optical Interpose, a novel platform that monolithically integrates both electronic and optical elements onto a single silicon chip. This patented approach aims to create smaller, higher performance, more power-efficient, and cost-effective products compared to conventional optical assemblies. By enabling the seamless integration of light sources, detectors, and other passive and active components, POET's technology is positioned to address the critical bandwidth and speed requirements of next-generation data centers, high-performance computing, and sensing applications. Let's start with the story that has everyone talking. POET Technologies is in the business of silicon photonics, a fancy term for using light instead of just electricity to move massive amounts of data inside data centers. As AI models get bigger and hungrier for data, the technology POET is developing becomes absolutely critical. They're not building the AI models themselves. They're building the high-speed highways that allow AI data centers to function. So, why the sudden surge of interest? Let's look at the possibilities, the reasons investors are getting excited. First, major financial backing. POET recently closed a massive $75 million private investment. This isn't just pocket change. This is capital meant to fuel aggressive research and development, fund strategic acquisitions, and scale their operations. In the tech world, a cash infusion like this is a huge signal of belief from institutional players. Second, real customer validation. This isn't just lab tech anymore. POET has announced significant production orders, including a $5 million order for their 400G Infinity optical engines and another $5 million order for 800G engines. These are tangible contracts that prove their technology is being adopted and integrated into real-world products. This has been a major driver behind the recent stock price surge. And third, the long-term vision. Analysts and supporters see a clear path for POET to become a key player in the optical engine market. If they execute perfectly, long-term projections suggest the stock could see astronomical gains by 2030 or 2050. The potential market in AI data center connectivity is enormous, and POET is aiming for a leadership role. This is why you'll see strong buy ratings from some analysts who believe in this long-term trajectory.
Now, let's pump the brakes and talk about the very real challenges. This is where it gets risky. The most glaring issue is in the financials. We have to be blunt. The numbers are not good. In 2024, POET's revenue actually declined by over 90%. Their profit margins are deeply in the red, with an EBIT margin of around negative 2,400%. Let that sink in. They are burning cash and are far from profitability. This makes valuing the company on traditional metrics nearly impossible. Because of this, the stock is highly volatile and speculative. Price movements are often driven by news announcements and investor sentiment, not by quarterly earnings. And speaking of sentiment, it's incredibly mixed. While some analysts are bullish, Weiss Ratings recently reaffirmed a sell or D- rating on the stock, pointing to these fundamental financial weaknesses. Finally, they are not in an empty field. The competition in the semiconductor and silicon photonics space is fierce, with giants and other startups all vying for the same prize. POET's technology is promising, but they need to prove they can achieve sustained commercial success against well-funded rivals. POET Technologies is a quintessential high-risk, high-reward investment. It's a bet on a promising technology in a hyper-growth market, backed by recent capital and real customer orders. The potential for life-changing returns over the next decade is there. However, it's also a bet against terrible current financials, high volatility, and significant execution risk. This is not a stock for your retirement core portfolio. It's not for the faint of heart. On one hand, you have the majority of Wall Street firms covering the stock taking a cautiously optimistic stance. The current consensus rating among 4 analysts is a moderate buy. 3 of those 4 have issued either a buy or strong buy rating. These are firms like Northland Capital Markets, Craig-Hallum, and H.C. Wainwright & Co., who have consistently reiterated their positive outlook. On the complete opposite end of the spectrum, we have Weiss Ratings, which recently reaffirmed a strong sell rating on the stock, giving it a grade of D-. Their concern isn't about the technology's potential, but the company's fundamental financials and underlying risks. This is a crucial reminder that for small, pre-revenue or early revenue tech companies, a great idea doesn't always translate into a successful business. Now, here's where it gets really interesting. If you take the consensus price target from all these analysts, it sits around $6.25. But as of recording this, the stock is actually trading above that price. This means the average analyst sees downside potential in the short term. It suggests that while they like the story long-term, they believe the stock might be a bit overheated right now. What do you think? Is the potential worth the risk, or are the fundamental concerns too great?
Navitas Semiconductor Corporation, ticker NVTS. Navitas Semiconductor Corporation is a pioneering technology company and a global leader in the design, development, and marketing of gallium nitride power integrated circuits, which are considered a next-generation high-performance replacement for traditional, less efficient silicon chips. By leveraging GaN technology, Navitas enables significantly higher energy efficiency, faster charging, and reduced size and weight in power electronics for key end markets, including mobile fast chargers, consumer electronics, data centers, renewable energy systems, and electric vehicles.
The company's mission is to revolutionize electrification and help reduce carbon emissions by providing the world's most efficient and compact power solutions. This stock has been on an absolute tear, up over 400% in 2025. But is it a groundbreaking investment for the long haul or a speculative bubble waiting to pop? Their secret weapon is gallium nitride, or GaN. Think of it as the next generation of silicon. It's faster, more efficient, and generates less heat. And Navitas isn't just a player there. They were a pioneer integrating GaN into powerful all-in-one chips. Their innovations, like the world's first bidirectional GaN chip, are a big deal. This means simpler, smaller, and cheaper power systems for a huge range of products. We're talking about electric vehicles. They've secured over 40 design wins in the EV market, including a partnership with China's Chang'an Auto. More efficient power conversion means longer range and faster charging. Data centers. This is a massive growth area. AI chips from companies like NVIDIA are incredibly power-hungry. Navitas is partnering to provide the energy-efficient power solutions needed to keep these data centers running without melting down. This is a direct play on the AI boom. A strong moat. With over 200 patents, they have a technological head start that's hard to copy. So the narrative is strong. A cutting-edge company in all the right high-growth markets. It's easy to see why investors are excited. Now, let's flip the coin. Because for all the futuristic promise, the present-day financials tell a more challenging story.
Here are the major red flags you can't ignore. The financial reality. Navitas is not yet profitable. They're burning cash, and their revenue actually declined by about 40% in their last quarter. For a growth stock, that's a major concern. The path to sustained profitability is filled with execution risk. Fierce competition. They may be a technology leader, but they're a small fish. They're up against giants like Infineon and Texas Instruments, who have massive resources, manufacturing scale, and existing customer relationships. Navitas's fabless model, relying on TSMC to make their chips, could be a disadvantage against these vertically integrated behemoths. The valuation question. After a 370% rally, is the stock overvalued? Many analysts think so. The consensus price target suggests a potential downside from current levels. The market seems to be pricing in perfect execution for years to come, which is a very high bar. Are the insiders selling? This is a big one. Insiders have sold over $137 million worth of stock in the last 2 years, including $12 million in 2025. While there can be many reasons for selling, it inevitably raises questions about their confidence in the short-term price. The overall picture from analysts is one of caution. The consensus rating for Navitas is largely a hold. Out of 8 to 10 analysts covering the stock, the majority are on the sidelines. The breakdown typically shows about 4 saying hold, 2 saying buy, and 2 even recommending sell. This immediately tells us that the expert community isn't wildly bullish at these price levels. But the real story is in the price targets. This is where it gets interesting and, frankly, a little concerning for bulls. The average analyst price target sits around $5.83 to $6.32. Now compare that to the recent stock price, and this implies a potential downside of 30 to 55%. That's a significant warning sign. The range of targets is massive. On one end, you have Morgan Stanley with a stunningly low target of $1.50. On the other, you have Rosenblatt with a target of $12. And here's a key point. Even the bullish Rosenblatt recently downgraded Navitas from a buy to a neutral, suggesting they believe most of the near-term gains have already been made. So what's the final verdict on Navitas Semiconductor? Here's the summary. The bull case? You're betting on a leader in a disruptive GaN technology with huge long-term growth potential in EVs and renewables. The technical setup suggests there might be more short-term gains to be captured. The bear case and why analysts are cautious? The stock looks overvalued after its big run-up. There are real execution risks, and the financial performance needs to catch up to the hype. The average analyst price target points to substantial downside. So what do you think? Is Navitas a hidden gem, or is it too risky at this valuation? Let us know in the comments below.